Welcome, fellow investors, to today's insightful journey into diversifying your portfolio amidst the ever-evolving market landscape. In recent years, bond ETFs have been a stalwart choice for stability and income. However, as we face rising interest rates and persistent inflation, it's time to explore alternative strategies that can pick up the slack when your traditional bond ETFs might falter. In this video, we'll delve into the world of hedge fund ETFs, a fascinating avenue that offers greater diversification and the potential for positive returns in diverse market conditions. Stay tuned as we uncover the what, why, and how of incorporating these alternative investments into your portfolio. In recent years, investors have turned to bond ETFs to find stability and income in their portfolios. However, as interest rates rise and inflation persists, traditional bond investments have faced challenges. In response, some investors are exploring alternative strategies, with a particular focus on hedge fund ETFs. What are hedge fund ETFs? Hedge fund ETFs are exchange-traded funds that mirror the performance of hedge funds, investment vehicles known for employing diverse strategies such as short selling, derivatives, and arbitrage. These ETFs provide access to hedge fund strategies without the high costs and illiquidity associated with individual hedge fund investments. Why consider alternative hedge fund ETFs? Investors have compelling reasons to consider alternative hedge fund ETFs. Greater diversification. Hedge fund ETFs offer more extensive diversification compared to traditional bond ETFs. Their ability to invest across various asset classes and strategies, including those uncorrelated with traditional bonds, enhances portfolio diversification. Absolute returns. Hedge fund ETFs have the potential to generate positive absolute returns, even in declining markets. Their flexibility in employing strategies that profit from market volatility can contribute to returns irrespective of market conditions. Transparency. Hedge fund ETFs adhere to the same reporting requirements as other ETFs, providing investors with transparency into the holdings and performance of the underlying hedge funds. 2 alternative hedge fund ETFs to consider. While numerous alternative hedge fund ETFs are available, 2 stand out. ProShares Hedge Replication ETF, HDG. The ProShares Hedge Replication ETF, HDG, is designed to replicate the risk and return characteristics of the hedge fund universe. This ETF employs a factor-based approach, aiming to capture the key drivers of hedge fund performance without directly holding hedge funds. HDG utilizes a diverse set of financial instruments, including equities, fixed income, and commodities, to achieve its objective. One of the primary advantages of HDG is its ability to provide investors with exposure to alternative strategies typically employed by hedge funds. These may include long/short equity, event-driven, and macro strategies. By incorporating these strategies within the ETF structure, HDG offers a liquid and cost-effective alternative to traditional hedge fund investments. Moreover, HDG's factor-based methodology allows for a more systematic and transparent approach to capturing hedge fund returns. This can be particularly attractive to investors seeking to enhance their portfolio's risk-adjusted returns while maintaining liquidity and transparency. IQ Hedge Multi-Strategy Tracker ETF, QAI. The IQ Hedge Multi-Strategy Tracker ETF, QAI, is another compelling option for investors looking to diversify their portfolios beyond traditional bond ETFs. QAI aims to replicate the risk-adjusted return characteristics of various hedge fund strategies by investing in a mix of other ETFs that represent those strategies. QAI's multi-strategy approach provides exposure to a range of alternative investment strategies, including long/short equity, global macro, market neutral, and event-driven strategies. This diversification across strategies can help mitigate the impact of underperformance in any single strategy, offering a more resilient investment solution. Additionally, QAI's use of other ETFs as building blocks makes it a cost-effective and easily tradable alternative to traditional hedge funds. Investors benefit from the liquidity and transparency inherent in ETFs, allowing for greater flexibility in managing their portfolios. Risks of alternative hedge fund ETFs. While alternative hedge fund ETFs offer unique advantages, they come with increased complexity and risks compared to traditional bond ETFs. Investing in hedge funds exposes investors to riskier strategies, potentially leading to wider swings in value than observed in traditional bond ETFs. Investing for the long term. Investors considering alternative hedge fund ETFs should carefully assess their risk tolerance and investment goals. These ETFs are most suitable for investors with a long-term horizon who can withstand substantial volatility. In the face of a challenging market environment, investors are exploring alternatives to diversify portfolios and generate positive returns. Alternative hedge fund ETFs present a potential solution, but it is crucial to comprehend the associated risks before making investment decisions. By understanding the intricacies and aligning investment strategies with long-term goals, investors can navigate market challenges effectively and incorporate alternative hedge fund ETFs into a well-diversified portfolio. Thank you for joining us today. Wishing you success in navigating the markets and building a resilient portfolio. Until next time, happy investing.